Welcome to our new IFRS Educational Fund series. It is an initiative of OJ Inspiration Limited. It is dedicated to providing complementary and supplementary education on international financial reporting standards IFRS through a multiple choice question and answer approach. It is intended to make learning or intellectual assurance fun. In this session, we shall be considering 10 questions to which the answers have been provided on both IFRS 3 and IFRS 10. IFRS 3 is the standard on business combinations, while IFRS 10 is the standard on consolidated financial statements. Viewers of subscribers have 30 seconds to select or choose the answer to each question. Please enjoy it. Question number 1. Preparation and presentation of consolidated financial statement is done under IFRS, where the reporting entity controls a minimum of dash A, 2 entities, B, between 3 and 5 entities, C, above 5 entities, D, 1 entity, E, many branches of the company. Time counts. Ten seconds gone. $20 seconds gone. Time up. The answer to question number 1 is D. When the reporting entity controls a minimum of 1 entity, that is all that is required for the preparation and presentation of consolidated financial statements in line with paragraph 1 of IFRS 10. Question number 2. In consolidated financial statements, the financials presented alongside that of the consolidated financial statements are dash. A, group of companies' financial statements. B, individual financial statements. C, separate financial statements. D, abridged financial statements. E, published financial statement. Time counts. Ten seconds gone. $20 seconds gone. Time up. The answer to question number 2 is C, separate financial statements. Separate financial statements are those of the parent company that are presented alongside consolidated financial statements when group accounts are reported. C is the answer to question number 2. Question number 3. For a parent company with 1 subsidiary with no sub-subsidiary, one of the following does not appear in a consolidated statement of financial position. A, goodwill. B, liabilities assumed. C, cash and cash equivalents. D, retained earnings. E, investment in subsidiary. Time counts. $10 seconds gone. $20 seconds gone. Time up. The answer to question number 3 is E, investment in subsidiary. The essence of the consolidated statement of financial position is to present as a single whole all the asset, liabilities, and associated non-controlling interest in a subsidiary. Therefore, the core investment in that subsidiary is not presented anywhere within the consolidated statement of financial position, because the entries, the components of the investments have been represented by the collection of the assets, liabilities, and the non-controlling interest presented in the consolidated statement of financial position. E is the answer to question number 3. Question number 4. A company that is acquiring another exchange equity interest with the company that is being acquired. Goodwill can be determined using the dash. A, net book value of the equity interest in the acquiree. B, net book value of the equity interest in the acquirer. C, average net book value of equity interest of the acquiree and acquirer. D, acquisition date fair value of equity interest of the acquiree. E, average acquisition date fair value of equity interest of the acquiree and the acquirer. Time counts. Ten seconds gone. 20 seconds gone. Time up. The answer to question number 4 is D, acquisition date fair value of equity interest of the acquiree. This is the provision of IFRS 10 towards the determination of goodwill in line with paragraph 33 of IFRS 3, which in itself is the standard that deals with the actual business combinations. The result of the concessions made under IFRS 3 is presented in the Consolidated Financial Statements required under IFRS 10. D is the answer to question number 4. Question number 5. Which of the following is not considered in the measurement of goodwill? A, consideration transferred. B, acquisition date net book value of assets and liabilities. C, amount of existing controlling interest. D, acquisition date fair value of the acquirer's existing equity interest. E, acquisition date net fair value of the identifiable assets acquired and the liabilities assumed. Time counts. Ten seconds gone. 20 seconds gone. Time up. The answer to question number 5 is B, acquisition date net book value of assets and liabilities. Acquisition date net book value of assets and liabilities is not considered in the measurement of goodwill in line with IFRS 10. Specifically, paragraphs 18 and 32 of IFRS 3 clarify this position. Question number 6. A company projects that it will make a bargain purchase gain in a target acquisition that will lead to control. Which of the following is not factored in determining the bargain purchase? A, advisory fee related to business combination not equity related. B, acquisition date net fair value of the identifiable assets acquired and the liabilities assumed. C, consideration transferred. D, amount of existing controlling interest. E, acquisition date net fair value of the company's existing equity interest. Time counts. Ten seconds gone. 20 seconds gone. Time up. The answer to question number 6 is A, advisory fee related to business combination, not equity related. This is not factored in determining bargain purchase in line with paragraph 53 of IFRS 3. A is the answer to question number 6. Question number 7. Unrealized profits on the sale of raw materials from a parent to a subsidiary where the inventories exist at a consolidation date are eliminated from dash. A, parents return earnings. B, subsidiaries return earnings. C, consolidated retained earnings. D, goodwill. E, provisions. Time counts. Ten seconds gone. 20 seconds gone. 'Time up. The answer to question number 7 is C, consolidated retained earnings. That is where unrealized profits contained in this transaction is eliminated from, in line with paragraph B86 of IFRS 10. C is the answer to question number 7. Question number 8. A subsidiary reported a contingent asset in its financial statements, while its parent reported a contingent liability. What will be the impact of this in the consolidated financial statements? A, consolidated retained earnings is affected by the net difference of the contingent asset and the contingent liability. B, the parent's retained earnings for consolidation is affected by its contingent liability. C, the subsidiary's retained earnings for consolidation is affected by its contingent liability. D, goodwill is affected by the net difference of the contingent asset and the contingent liability. E, consolidated retained earnings is not affected. Time counts. 10 seconds gone. 20 seconds gone. 'Time up. The answer to question number 8 is E, consolidated retained earnings is not affected. Contingent liability and contingent assets, whether of a parent or subsidiary, are not recognized in the financial statement. They are only disclosed. Irrespective whether the financial is that of the consolidated financial statement or that of the parent or that of the subsidiary in its individual financial statements. E is the answer to question number 8. Question number 9. The subtraction of goodwill from consideration transferred at acquisition date less acquisition date fair value of the net identifiable assets acquired and liabilities assumed is dash. A, the acquisition date fair value of an acquirer's previously held interest. B, non-controlling interest in the acquiree. C, bargain purchase. D, amount to be written off goodwill. E, amount to be written off consolidated retained earnings. Time counts. 10 seconds gone. 20 seconds gone. 'Time up. The answer to question number 9 is B, non-controlling interest in the acquiree. The question is about the formula for determining goodwill. The rearrangement of the formula for determining goodwill reveals B as the answer to question number 9. B is the answer to question number 9. Question number 10. Which of the following is still recognized in the financial statement of a parent that has just lost control? A, assets of the former subsidiary. B, liabilities of the former subsidiary. C, associated goodwill. D, investment in the former subsidiary. E, associated bargain purchase. Time counts. 10 seconds gone. 20 seconds gone. Time up. The answer to question number 10 is D, investment in the former subsidiary. Where control is lost, any remnant of interest in what was formerly a subsidiary becomes an investment. So this is still recognized in the financial statements of an entity that was once a parent which had lost control. D is the answer to question number 10. That is all for this set. Thank you for joining us for the set 1 of IFRS 3 and IFRS 10, which deals with business combinations and associated consolidation in financial statements. We invite you to subscribe to our channel, share our links, and invite those in your network to do the same. This will enable you and all other subscribers get direct notifications on future video uploads. We intend to cover all of the standards in this framework and create further sets of questions and answers on standards already covered. For collaboration in this area, please call or WhatsApp +234 9030 770109. Bye for now.